Hi, this is Gloria Hack with RE/MAX Park Creek, and it's a beautiful day. Today we're going to be reviewing 6 reasons that the housing market is not going to crash, so hang on. So, are we headed for a housing crash? It's a fair question. What's the answer? Housing economists agree that no painful crash is in the horizon. We don't have a bubble, says Logan Mansami, who is the lead analyst at Housing Wire. We just have unhealthy home price growth. Unhealthy home price growth. The sharp rise in home values isn't a sign of a bubble, okay? There's no bubbles. All of you who keep saying there's a bubble, there is no bubble. Housing economists point to 6 compelling reasons that there will be no crash. Inventories are at record lows. The National Association of Realtors says that there is just 2.1 months supply of homes for sale nationwide, which is up marginally from February, where there was just 2 months supply. That explains why buyers have little choice but to bid up the prices. And it also indicates the supply and demand equation simply won't allow a price crash in the near future. So one of the second reasons why we're not going to see a housing bubble or a housing crash is that builders can't build quickly enough to meet the demand. Home builders pulled way back after the last crash, and they never fully ramped up to pre-2007 levels. Now, there's no way for them to buy land and win regulatory approvals quickly enough to quench that buyer demand. While builders are building as much as they can, a repeat of the overbuilding of 15 years ago looks unlikely. The reason for the run-up in price is heightened demand and lack of supply. As builders bring more available homes to market, more home buyers decide to sell, and prospective buyers get priced out of the market. Supply and demand can come back into balance. But balance will not happen overnight. Mortgage rates remain near historic lows. After hitting all-time lows in January, mortgage rates have risen just a bit, but not that much. Freddie Mac's survey of lenders says that the average rate fell below 3% last week. Low rates give home shoppers increased buying power. The Mortgage Bankers Association expects rates to rise to 3.7% at the end of 2021. That could crimp refinancing, but not home buying, and really 3 to 3.7 is not that big of a difference. Demographic trends are creating new buyers. There's strong demand for homes on many fronts. Many Americans who already owned homes decided that during the pandemic that they needed bigger places. Millennials are a huge group and in their prime buying years. And Hispanics are a young, growing demographic keen on home ownership. Lending standards remain strict. In 2007, oh my goodness, liar loans, when borrowers didn't need to document income, were common. Lenders offered mortgages to just about anyone, regardless of credit history or down payment size. Today, lenders impose tough standards on borrowers, and those who are getting mortgages overwhelmingly have stellar credit. In fact, the typical credit score for mortgage borrowers in the third and fourth quarters stood at a record high of 786. the Federal Reserve Bank of New York says, if lending standards loosen and we go back to the wild, wild west days, I remember those days, of 2004 to 2006, well, then that's a whole different animal. So hopefully we won't see that. If we start to see prices being bid up by the artificial buying power of loose lending standards, that's when we worry about a crash. So hopefully we won't see that happen this time. Foreclosure activity is really muted. In the years after the housing crash, millions of foreclosures flooded the housing market, depressing the prices. And that's not the case now. Most homeowners have a comfortable equity cushion in their homes. More to follow. Lenders haven't been filing notices during the pandemic, pushing foreclosures to record lows in 2020. Speaking of foreclosures, while there has been a moratorium on foreclosures, there's still foreclosures on vacant and abandoned properties. There's also been a higher level of commercial property foreclosures. FHA loans are the most likely to be foreclosed because you're only putting 3.5% down. While homeowners have been asked for forbearance, more time making payments has eroded their home equity. So if you're not making your payments, you're losing some of your equity. The forecast for foreclosures in the next 5 years is 1.3 million. Now mark that, 1.3 million. In the worst period from 2008 to 2012, there were 4.8 million foreclosures. So big difference. In 2020, only 23% of the pre-foreclosure sales were short sales, which means they owed more than the house was worth, which could account for the eroding equity due to these non-payments. So the forecast is that there is a demand for housing, that the real estate values are increasing slightly in the next 18 months, and they're expected to stay flat in 2023. This means the real estate market isn't going to crash, okay? It's not going to crash. So if you were thinking it's going to crash, it's not happening. If you like this video, check out some of my other videos and make sure to subscribe so you don't miss anything.